Investing. That's about knowing when to buy and when to sell stocks, right? It's about bubbles, crashes, and timing the market. When people think about investing, this is what they usually think about.
The law of gravity hit Wall Street.
But what if we told you anybody can be an investor, especially if you're investing for the long term? Because when it comes to long-term investing, time in the market is more important than timing the market. In this series, we challenge some of the biggest misconceptions about investing by looking at true stories in investment history. And in the process, we'll teach you some of the basic ideas every investor should know. Let's begin by taking a closer look at one of the biggest stock market hypes from not so long ago in the 1990s, the dot-com bubble, and the crash that followed.
Well, the late 90s was an incredibly exciting time if you were an entrepreneur, an investor, or actually a journalist watching what was going on.
And they've grown very rapidly in the last couple of years on the back of the success of a game called Lemmings.
There was a huge buzz in the air. There was a certain unreal feeling to it, but there was an idea that anyone with a smart idea could start a business and possibly become very rich indeed in a very short amount of time.
It's living the American dream.
If you sort of look back over my shoulder, it was all happening in this area. The 1990s was a time when most investors looked around and saw a revolution, an information revolution, a digital revolution. And everything looked like it was changing in terms of e-commerce in particular, electronic commerce, that we would wind up being able to order all kinds of things, not by having to go into stores, but looking at screens. Imagine what an idea that was in the 1990s.
You get whatever it is in the world you want from the World Wide Web. Lycos, go get it.
Same groceries, no store. Webvan, you may never go to the grocery store again.
And with the new companies came new opportunities for investors.
Everything started in 1995 when a company called Netscape,
Next time you're on the internet, go to the new Netscape.com.
IPO'd in New York. It was the first web browser. The company was a little more than a year old, and its shares went boom. Lots of other businesses getting revenue in the early stages. Their priority was not to balance the books. Their priority was to grow as rapidly as possible, build it and they will come, as it were, and worry later about actually turning a profit.
This is a revolution underway that's affecting the way we do business and live our lives.
And investors bought into this mantra wholeheartedly.
So there's this general sense that it wasn't just tech stocks. The world had changed in terms of the information age. That had changed investors' comfort with investing in stocks of all kinds, not just high-tech stocks. And that was going to lift the market and keep it up permanently.
When you're on top of that wave and you're surfing, you got to ride it to the end.
But in the spring of 2000, the wave broke and stock prices fell across the board.
Traders say this is the craziest day they have ever seen.
It was the worst day on Wall Street.
The dot-com failures continue to mount.
So as an investor, how do we deal with these kinds of bubbles and the inevitable crashes? Well, let's start by trying to understand the mechanics behind them. For long-term or value investors, a company's stock prices should reflect fundamental values, which are based on data like a company's income, revenue, and cash flow, as well as its competition and growth potential.
When the stock market goes into a period that we call frothy, market values tend to rise above fundamental values. And investors become very enthusiastic. Most investors, including some professionals, really don't take time or make the effort to compute fundamental value. They just know stocks are going up. So they buy more stocks, and that tends to push stocks up even higher. And so stock prices during a bubble rise much faster than what those stocks would be worth to a long-term investor who would be only buying and holding.
Prices continue to rise until they reach a tipping point.
It happens because investors become disillusioned all at once, that the good times are over. And so they bail all at once. The rises are dramatic. but nowhere near dramatic as what happens when the switch gets flicked.
In less than 2 hours, nearly $10 billion invested in stocks was simply wiped out.
Today is Black Monday, the day the Dow dropped more than 500 points. It's around the world, stock markets fell faster than a skydiver without a parachute.
It's a panic. Everyone's in panic.
Lehman Brothers filed for bankruptcy.
This could be the most serious recession in decades.
What drives investors, even the professionals, to behave in this irrational way?
So usually the beginning of a bubble, stock market bubble, involves a sense of euphoria. Usually it means that there are dopamine flows that have increased and are channeling through some investors' reward centers in their brain. That induces them to become excessively optimistic about the future. And that typically means that they underweight the likelihood that there'll be bad news coming, and they attach too high a weight to the fact that there'll be more good news coming down the road.
It can be our psychology trying to get the better of us.
We have greed within us. So we all want to make 10% in the next 2 weeks. But I really try and hold myself back and not fall into that pattern at all, and really try and stay realistic. Anyone who promises you like 15, 20% per year, careful, because that's all, there's going to be high risk in that.
The very nature of a bubble is that people kind of lose touch with reality. There is that classic phenomenon, FOMO, fear of missing out. You hear that your mate has just bought some shares in a company and doubled his money in a matter of months, and you want some of that too. You don't listen to your other mate who's lost money. You hear only good news.
That last part is what in behavioral economics they call a cognitive bias.
So we like information that confirms a view that we hold, especially if it's a view we want to hold. And we don't like information that is disconfirming, that goes against the view we hold, especially if it's a view we want to hold. So we call this particular psychological tendency confirmation bias.
And that's not the only bias to look out for.
So extrapolation bias is the tendency to look at what has been and ask yourself, if that pattern persists, the one I've just spotted, and I extrapolate it into the future, what will the future look like if the future is an extension of the past? And sometimes it will give you a decent prediction, but it will also set you up for a massive failure if you've been lucky rather than smart.
After the dot-com crash for the companies that survived, it took some time for stock prices to recover. Hypes can work both ways, though, meaning after a crash, companies can also be undervalued.
The stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way. You know, a financial bust like the internet bubble bursting is, makes it really hard to raise money. But, we already had the money we needed.
I have a 5-year horizon, and I really fixed myself on that. So I have no problem at all in staying calm in the short term. And on the contrary, actually, I'm always happy for opportunities where there's panic out there, because those are the opportunities where I will really try and commit and invest more.
So let's also zoom out for a second and put these panics and crashes into perspective. We're used to seeing this, pretty scary. When we look at the bigger picture, though, over the long term, something interesting happens. Over the long run, those big crises just look like bumps in the road. So do we have to ignore those dopamine flows completely?
I like to tell my students about a concept called fun money. We want to understand that some people invest because they're sensation seekers, because they're looking for thrills. Some people climb mountains, others hold speculative stocks. There's nothing inherently wrong with that if you're careful about doing it. But on average, if you invest for fun, invest money you can afford to lose, and keep that money separate from the money you put away to invest for your long-term welfare. And maybe you'll be even lucky, because when you invest for fun, you might actually wind up generating a high return out of it.
Stock market bubbles and crashes can make for bumpy rides, but it's important to remember to stay calm and keep an eye on your long-term plan. Whether it's enjoying your short-term fun money or patiently inching towards that long-term exit point, or investing in what you believe in. More on that in the next episode.